Here's the ultimate guide to finding your first real estate deal. Shannon Robnett here, and today I'm sharing exactly how you can buy your first piece of real estate using the Intelligent Investor Framework. In 2025, the real estate market is facing some very significant shifts, especially with inflation rates remaining fairly high and interest rates still elevated. What worked for investors 3 years ago might not work today and might need a bit of adjustment. However, by following the right sequence and leveraging the Intelligent Investor Framework, you can still succeed in a changing and challenging market. So let's go over the 5 key essentials I look for in every deal. First, the deal itself. This is the property, its location, what it does, how it functions. With market conditions changing in 2025, location is more important than ever. Demand for real estate may vary, but focusing on high demand areas will keep your investments safe. Second, we need the debt on the deal. While debt is crucial in structuring a deal, with interest rates being higher, securing favorable debt terms in 2025 will require more negotiation and a solid relationship with your lenders. Leveraging debt is strategic and necessary. The third is the cash or the equity in the deal. This is where most investors get tripped up. You don't need to have cash up front to buy real estate, and I wish someone had told me that years ago. Even in 2025, cash is important, but it's not the end-all be-all. You can get creative with financing and a strong network, and that will make a huge difference in how this process works for you. Fourth, you need a network. You can't do real estate alone. You'll have the government, the banks, your investors, your residents, insurance companies, and property taxes, managers, repairs and maintenance, all kinds of things. And in 2025, virtual networking will be just as crucial as traditional face-to-face relationships. So engage with brokers and investors through digital platforms, attend webinars, leverage social media for a wider reach. These things will help you build and grow your network. And fifth, you got to have confidence. Confidence is what will keep you going through the rough patches, but you can't just fake it in real estate. If you try, you'll fail. True confidence comes from having the right deal and the right strategy in place, which the Intelligent Investor Framework definitely provides. Now let's talk about finding that perfect deal. The key to success is focusing on the right deal and following a specific sequence. Remember, the deal itself makes up 80% of the work. The debt comes in at 15%, and cash only accounts for 5% of what really happens in a real estate deal. But both debt and cash come from your network, which is why getting the right deal can help you grow your network faster. Let's just break this down. If you've got a fantastic deal, finding the debt and the equity is a lot easier than trying to sell a mediocre deal. So really be selective when it comes to finding your deals and what you're taking to market to bring in front of your network. Because if you're looking for deals, one of the best approaches is to build relationships with brokers in the markets you want to be in. Because brokers are familiar with the local real estate scene, and they can often present you with opportunities you won't find on platforms like Crexi or LoopNet. By working closely with them, you'll have access to a wider range of deals and move faster than most investors, putting you at the head of the race. But once you find that deal, don't overcomplicate things. Pick up the phone, call the broker, get some insight from them. Many investors waste time trying to decide whether the deal is good or not, but what you need to do is call. Reach out to people, talk to leasing agents, talk to brokers, talk to your network. And after your call, you can quickly underwrite the deal to figure out the price and potential returns on your side. As you talk to the brokers, make sure to ask questions. Ask about the market, the property's features, what the seller's expectations are, and what other opportunities might be available in a similar product. This helps you to build a relationship and understand what's really going on in that sector of the market. After you've underwritten the deal, build that relationship again. It's time to get control of the asset. You can do this by getting a letter of intent or an LOI. The LOI shows that you have control of the deal even before you have all the details hammered out. And the next step is to get debt quotes. But don't go asking for debt quotes unless you have the deal under contract. Without it, you're just guessing, and everybody knows you're probably just going to waste their time. But once the debt is secured, it's time to start raising equity. Look for deals that are bigger than what you can personally fund. The bigger the deal, the more equity you'll need, but that also means there's an opportunity for greater returns because real estate has a leverage factor to it. This is where a strong network of investors really comes into play. After the debt and equity are lined up, it's time for due diligence, and this involves reviewing the property rent rolls, plumbing, structure, and everything else that makes this something that's not going to bring you any surprises. Typically, you'll spend about $26 per unit on due diligence. For example, a 200-unit property could cost you about $5,200 for due diligence, testing, inspections, things of that nature. But once the due diligence is done, you're ready to close the deal because all your questions are answered. And that's a key point. Due diligence is designed to answer all your questions. If you still have questions after your due diligence, it's either time to drop the deal or go back to the brokers and renegotiate to get those questions answered. And if there are any issues that come up, like plumbing problems or undisclosed issues, you may need to renegotiate those terms to make sure that you have a clear path forward that leads you to profitability. When you close the deal, it's time to manage the property. And this is where many investors get nervous. But trust me, managing a property, especially a big one, isn't as hard as it seems with the right network. The hardest part, finding the right deals and finding the right players. With the right players in place, you can manage anything. And lastly, the key to improving the property's value is to increase the rent and lower the expenses. That doesn't mean forgetting about cosmetic fixes just to raise the rent and control expenses, but it means finding that blend because that is the best way to boost your property's value. In the end, always have multiple exit strategies in place. Don't buy a property with only one way out. Warren Buffett taught me that the key to success in investing is having multiple ways to win. I hope this video has been helpful. If you enjoyed it, make sure to hit the subscribe button, turn on the notifications, and leave me a comment below. And thanks again for watching.